Welcome back to Learn SKN, and today we're going to continue looking at some CSEC economics. And so the last video we were looking at the circular flow diagram, and so you can check that video to find out what we discussed about that one. But today we're going to look at all things GDP, GNP, and national income. So gross domestic product, gross national product, and national income. But before we do so, you know what to do. Like the video, subscribe to the channel, hit the bell so you know when Learn SKN drops another CSEC economics POB video, econ video, agri video, MOB video, whichever one, we don't know, hit the bell. Alright, so let's just jump right into what we're looking at today. So today we are going to be looking at section 5, discuss the differences among gross domestic product or GDP, gross national product, and national income. We're going to try and discuss those differences. Then calculate gross domestic product, GDP, and gross national product, GNP. And interpret gross domestic product, GDP, and gross national product, and national income. So we're going to try and tackle those three objectives today. We started before, and so we're going to try and tackle them today. So the first objective, 5. Differences between GDP, GNP, and NI, national income. So, GDP, a measure of a country's output. GNP, a measure of a nation's output. And NI, the increase or decrease in standard of living. So, we're going to delve deeper into these two. So, right here in our textbook, we're going to start looking at national income. So, economists calculate national income statistics to measure the economic activity. Give me a second. Economic activity in an economy. So national income is a measure of economic activity in an economy over a given period of time, usually 1 year. So it's a measure or calculation of economic activity in an economy over a period of time, usually 1 year. So it is basically all of the measure of all the net economic activity over a period of time, usually 1 year. So this is after all of the GDP and GNP has already been decided. The end result would be something what we will call national income. So that's basically the net after everything has been sorted out and things like that. So if you come down here, look at this down here. We have GDP right here. Then we would minus the net property income from abroad. That we'll explain later. You end up with GNP. Then you less the depreciation or the capital consumption. And that is how we end up with national income. So after all that has been sorted, what results is the national income. And that makes it different to GDP and GNP. National income can be calculated using one of three methods. We have the expenditure method, the income method, and the output method. So if you look here at this slide, we can see there exist three conventional methods of measuring national income. We have the income method, the expenditure method, and the output method. Income method, it seeks to find the value of incomes in a given year. Expenditure method, total spending or sum total of money spent in a given year within an economy. Output method, value of goods and services produced in a given year. So those are the three methods used in calculating GDP or national income, all of them, GDP, GNP, all of them. So income method seeks to find the value of incomes in a given year. Expenditure method, total spending or sum of total money spent in a given year. Output method, value of goods and services produced in a given year. And no matter which one you choose, which angle you choose, you are supposed to end up with the same amount. And the reason for this is because what they're saying here is that the income that somebody earns, they can use that to purchase goods or services. And that money that they hand over to a business would be that person's expenditure. It would be that business's income, but it is that person's expenditure. And let's say you want to buy, I think the book has a nice example right here. So the book says, the three methods, expenditure method, the income method, and the output method. The total expenditure in the economy is equal to the total of all factor incomes earned, which in turn is equal to the value of total output in the economy. And the example is here. For example, when you go to a shop to buy a kilogram of flour, you pay $10 over to the counter. That is expenditure for you, the buyer. But that $10 represents income for the shopkeeper. So you see how it would be equal. If I'm going from the expenditure method, I get $10 because that's what you spend. If I'm going from the income method, then I get $10 because that is what the shopkeeper got for income from me. And then the flour that I'm buying, the value of that flour is $10. So the output, the value of that output is also $10. So that is why the three different methods should equal to the same value. So we have national income or GDP, and these are the components: consumption, investment, government purchases, or net exports. And so we have consumption being C, plus I, which is investment, plus G, which is government spending, plus X minus M, which is net exports. So that is the formula for calculating GDP. That's the formula, right? So if you do economics later on, this will come natural to you. Y represents national income or GDP, equal C plus I plus G plus X minus M. That is the formula for calculating national income, GDP, whichever one you choose to call it. And so this is the formula we'll be looking for. But what exactly these components stand for? So we have C, consumption. That's basically household spending. So consumption represents household. So all the households in the economy, their consumption, their spending on goods and services, except for when they're purchasing a house. That is not included in their consumption. That is not a part of C. So if you see anything about house, building a new house, purchasing a new house, that is not a part of C. It is, however, a part of I, which is investment. So the I in the formula stands for investment, and that's basically spending on capital equipment or inventory and structures, including new houses. So that's investment. And normally that comes from the side of businesses or firms. Firms normally the ones who lead the investment charge. So I means investment. Then we have G, which stands for government spending. That's G, government spending. So G, spending on goods and services by local, state, or federal governments. But G does not include transfer payments such as money to pensioners, money for welfare, money for unemployment benefits, those things. Right? That's not a part of G, government spending, because they did not get any production in return for that. So G represents government spending, but not as relates to transfer payments. And then we had X minus M, which is net exports. So those are the components of GDP, right? Components of GDP right here. Y, which is national income, equals C plus I plus G plus X minus M. Those are the components of GDP, national income. And we say that GDP is the monetary value of goods and services produced within an economy for a given period of time, usually 1 year. Right? So that's where we're at. So again, GDP, national income, which are sometimes used interchangeably, sometimes is a measure of the monetary value of goods and services produced within a country over a specified period of time, usually 1 year. Let's say, in essence, it is the sum total of all factor incomes in the economy and can be measured by 3 approaches: income, expenditure, and output. So that is GDP, or national income. That's GDP right there. So what they're saying here is that to cut GDP, what GDP is, gross domestic product. That's what GDP stands for, gross domestic product. Gross normally means the total before anything is taken out. So your gross pay is the payment you receive before any subtractions. So gross domestic product, that's the total amount, monetary value of all the products, goods and services produced within the economy domestically. That's where domestic comes in, domestically within the economy. So saying it's the total of all goods and services, the monetary value of all goods and services produced within the economy of St. Kitts over a given period, usually 1 year. That's GDP. The total value of all goods and services produced within St. Kitts over a period of time, usually 1 year. That is what we call GDP, right? It measures the total amount of goods and services, the total value of goods and services produced within a country, so St. Kitts, over a period of time, usually 1 year. That's what GDP is. Do we understand that? So when we say St. Kitts, the GDP of St. Kitts is 1.5 billion. Well, million. 1.5 million US. That is the value of everything, goods and services produced within St. Kitts over a period of time, usually 1 year. They normally measure GDP, gross domestic product, in annual terms. When they say America has a GDP of 20-something trillion, they're talking about for the year. Right? So that's what GDP is, that's what it means. So if we're looking at our syllabus, and they're asking us to say the difference between those two, the differences would be in the definition, of course. So we covered GDP, gross domestic product, the monetary value of all goods produced within an economy over a period of time, normally 1 year. That is GDP. Remember I said GDP stands for gross, as in nothing has been subtracted as yet. Now we move on to what we call GNP, gross national. Gross national, that's what the N stands for, gross national product. Gross national product. But when they say national, we're referring to the monetary value of all goods produced by factors of production owned by nationals of a particular country, right? So the monetary value of all goods produced by factors of production owned by nationals of a given country, right? Owned by nationals of the country. So it could be that they live Antigua, they could be that they live Trinidad. Once they are nationals of St. Kitts, let's say, for example, then we're going to calculate that. We're going to add that to our calculation. And if, for example, someone here is producing something, but they are not from here, if they're not Kittitians, then that money will be taken out of our GDP, sent over wherever, and then monies are the value of things from overseas that are owned by nationals is added to our calculation to get our GNP, gross national product. So GDP, gross domestic product, it measures it's the monetary value of all goods and services produced within the borders of a country for a given period of time, usually 1 year. So let me eliminate the period of time story. GDP, gross domestic product, is the monetary value of goods produced within the borders of a country in a year. That's GDP. The monetary value of goods and services produced within the borders of a country over a given period of time, usually 1 year. So we're stressing within the borders of a country. So that means anything produced within St. Kitts, anything produced in St. Kitts, that's going to go towards GDP. Now the difference between GDP and GNP is that GNP does not include the value of goods and services produced in a country that are owned by non-citizens. If they are owned by non-citizens, we minus that. We don't add that. That is not a part of GNP. GNP is just about citizens. What the Kittitians, what the value of the goods and services produced by Kittitians, whether they are home or the overseas. That's just it. So GNP does not include the value of goods and services produced by foreigners. It's not in GNP. So do we understand a simple difference right there? Do we understand the difference? That GDP is the value of goods and services produced by anybody once they're in the country. We add that to GDP. Once they're in the country, we add that to GDP. But GNP only includes the value of goods and services produced by factors of production owned by nationals. Owned by nationals of a country. And it doesn't matter whether they are home in the country or the overseas. We're going to add it together, and that's going to be our GNP. We're going to take out the foreigners, we're going to add in all the nationals, and the result would be our GNP, gross national. So the amount of goods and services produced by nationals of the country over a period of time, normally a year. So that's a key difference between GDP and GNP. One calculates both nationals, the value of goods produced by both nationals and non-nationals, but GNP is just for nationals only, like Kittitians only. So when you say GNP, that's the value of goods and services produced by nationals, Kittitians only. They could be here, they could be overseas. Once they are Kittitian and they're producing, the value going to be added to get GNP. Now they ask us to calculate gross domestic product and gross national product and national income. They ask us to calculate these things. And so we would have already started looking at how we calculate gross national product. Remember? So it's right here. So it's C plus I plus G plus X minus M, and the answer would be our GDP. That's just it. The answer is our GDP. Right there. C plus I plus G plus X minus M. That is how we get our national, our gross domestic product. Right? So that is how we calculate gross domestic product. Now, to calculate GNP now, right? To calculate GNP, what we have to do now is, remember I told you, keep this in mind, remember I told you, to find out GNP, we have to add the incomes from nationals who are overseas, and we have to minus the incomes of non-nationals who are on the island. So when you do that, we end up with gross national product. So if you look at it here, your GNP comes from GDP, right? GNP comes from GDP. So you have to have the GDP first, and then you can calculate your GNP. Because once you have your GDP, all you have to do is minus the incomes that are earned from non-nationals. You minus that, and then you add the incomes earned by nationals from abroad. So you minus the incomes earned by non-nationals in the country, and then you add the incomes earned by nationals overseas, and that answer would give you GNP. Look at that, let's follow it, right? Look at the diagram on the screen. So, we're gonna break it right down. So, gross domestic product, we know what that is. This is gross domestic product. The monetary value of all goods and services produced within the economy over a given period of time, usually a year. That's GDP. GNP now is the monetary value of all goods and services produced by factors of production owned by nationals over a given period of time, usually 1 year. How do we move from GDP to GNP? So this slide is American, so you can just substitute America for St. Kitts. So you have gross domestic product already. What you do, you add. Remember I told you that GNP is all about the value of goods and services produced by factors of production owned by nationals, whether they are home or abroad. So to move from GDP to GNP, what you do first, you add the incomes earned by citizens outside of St. Kitts, outside of the country. So persons who are overseas, when they produce something over there, using factors owned by them, Kittitians, nationals, you take that amount and you add it to our GDP. Same way, you're going to minus from GDP, from that total, you're going to minus the value or the incomes earned by non-nationals. By non-nationals that are located in the country. And the end total would be what we call gross national product. So keep this in mind. Keep it in mind. Remember, GDP is the value of goods produced within the economy. It doesn't matter if you're a foreigner or you're local. All it come together to form GDP. GNP is the monetary value of goods produced by nationals, whether they are home or abroad. So how do we end up with GNP? What we have to do now is take GDP and we're going to minus the incomes earned by foreigners that live in St. Kitts. We minus that from our GDP. Take that out. That ain't part of our GDP because you are a foreigner, and so we don't count that in our GNP. So foreigners, the income earned by them, minus that from GDP. Then we're going to add the income earned by nationals who are overseas. So nationals of St. Kitts who are overseas producing, we are going to add the value, the monetary value of those goods and services produced by those nationals over there to our GDP, and the end result is going to be our GNP. The new total is going to be what we call gross national product, GNP. Those are the two things you have to do to GDP to get GNP. First, you minus, it doesn't matter which way you go. You add the value of goods produced by nationals who are overseas, and then you minus the value of goods that are produced by non-nationals living in that country. And the end result is GNP. Now, if you are to reach all the way down to national income, the new total we have, so the total we have for GNP now, how do we find net national product? How do we find net national product? What you do is, from GNP, you're going to minus what we call depreciation of equipment. Okay, so if you have a car, right? You have a car, and let's say you bought the car for $10,000. Now, what happened next year? You cannot sell the car for $10,000. It will be valued at less. A normal car, you're going to be valued at less. So depreciation is a measurement of that wear and tear, right? It's a reduction in the value of that particular good. So in terms of investment, remember when you invest in certain things, right? You invest in certain things, that the value don't stay the same every year, because as you use things, right? As you use the equipment, you have wear and tear, and the value start declining. But in accounts, sometimes you have a set value in which it declines by. So for example, again, you have a car, they might say this car loses $500 in value every year. So 500 would be that depreciation. So the depreciation is the reduction in the value of that equipment. That's called depreciation. So you minus that from your gross national product. So in this case, there's a depreciation of capital equipment, meaning your factories, your equipment, year over year, they lose value. And so the amount of the value that you lose, you minus that from GNP. So if you have GNP, you're going to minus the depreciation value. Normally, they would give you in the table, they'll put in depreciation of capital goods. Or another name for depreciation is what we call capital consumption, right? So another name for depreciation is capital consumption, right? You see it in the textbook. So GNP minus capital consumption will give you net national product, or NNP. So that's how we calculate net national product, right? So from GDP we can get GNP. From GNP we can get net national product, which is you just minus the depreciation value from GNP, and then that total, what we call net national product, if we minus the taxes, right, sales and excise taxes, then we end up with what we call national income. So we finally arrive at national income, because when we minus the sales taxes and excise taxes, we end up with what we call national income. But in the textbook you will realize something. In the textbook you'll realize that they call net national product the same thing as national income. Now the reason why they are doing this is that in the textbook they highlighted two things: gross domestic product at different values. You can have gross domestic product at the market price, that's the going price. So you calculate the monetary value of all goods and services using the price that they have right now, and that would give you GDP at market price or market prices. But if you use that total and then you minus taxes and you add subsidies, then you will get GDP at what we call factor cost. Because what you would realize is that at market price, it doesn't really give you the true value per se of the goods and services, because taxes would increase the price of goods and services and subsidies will reduce the price of goods and services. So that's not really giving you true value. That's just at market prices. But if you take GDP at market prices and you minus the taxes and subsidies, then we end up with GDP at factor cost. And so if you use the value of GDP at factor cost and then you minus depreciation and everything, then you would end up with net national product, which is also called national income, because you already minus the subsidies and the taxes from GDP at market prices. So everything flows, everything comes down, everything flows, right? Everything flows from one thing to the next, one thing to the next. So you start with GDP, and from that you can get GNP. From that you can get what we call net national product, and from that we can get national income. So that is how we calculate gross domestic product, gross national product, and national product. So we're gonna stay there for now. That's it for this video. So you know what to do again. Like the video, subscribe to the channel, share the content, and tune in next time when we continue to look at section 6 of the SKN Econ syllabus. We're going to look at how we interpret GDP, GNP, national income, etc. But in the meantime, you can check out my playlist with all the previous content, the previous economic videos and POB videos, past papers, your choice. So check it at the end of this video. That's it for now. Thanks for watching and thanks for listening.